There's this whole other side of the stock market, a place that handles a huge chunk of all the trades. But most people, they've never even heard of it. We're talking about systematic internalizers. And today we're going to pull back the curtain on this market you don't see.
All right, so let me ask you something. When you think about buying a stock, say a big European company, where does that trade actually happen? Your first thought is probably a public exchange, right? The London Stock Exchange, Euronext, something like that.
Well, here's the crazy part. A massive chunk of that trading, we're talking up to 40%, it doesn't touch a public exchange at all. Nope. It happens somewhere else, on these off-exchange venues. And that brings us right to the main event today, the systematic internalizer, or as we'll call it, the SI.
Okay, so what are these things? How does this system, which is quietly handling billions and billions in trades every single day, actually work? Let's dive in.
So, in simple terms, a systematic internalizer, an SI, is basically an investment firm. Think of a huge bank or a high-frequency trading shop that decides to execute your trade itself. Instead of sending your order out to the big public market to find a buyer or seller, they just step in and use their own money to become the other side of your deal. It's like they're their own mini-exchange, just for their clients.
So here's the best way to think about the difference. A public exchange, that's like a massive, chaotic public auction. You've got thousands of people shouting buy and sell orders, all competing in the open. But an SI, that's more like walking into a private car dealership. You go directly to them, they give you a price for the car you want, and boom, the deal is done, just between you and them. It's private, it's direct, not a public free-for-all.
So you got to be asking, how did these private dealerships get so huge? Well, it's actually a super interesting story of good intentions and a massive unintended consequence. And it all starts with a huge piece of European regulation called MiFID II.
You see, the whole point of MiFID II, back when it rolled out in 2018, was to do the exact opposite of what actually happened. Regulators wanted everything out in the open. They were really concerned about so-called dark pools, these totally private venues where you can't see any prices. Their goal was to force all that trading onto the lit public exchanges, where we can all see what's going on.
But, and this is the million-dollar but, buried in the rules was a special section for systematic internalizers. Now, this was originally just for handling really big, sensitive trades that couldn't be dumped on the open market. The thing is, the rules for SIs were way more relaxed than for the public exchanges. And this created a gigantic loophole. So instead of all that trading moving into the light, it just found the path of least resistance and absolutely flooded into the SI world.
And I mean, to really get a sense of the scale here, just look at this. Before MiFID II, there were 14 firms registered as SIs in all of Europe? That's it. It was a tiny niche corner of the market.
And then, after MiFID II hit, wow, that number just exploded. We're talking over 100. Suddenly, all the big banks, the high-frequency traders, everybody wanted in. They all rushed to set up their own SI shops. And the result? It's pretty staggering. Today, SIH handles somewhere between 30 and 40% of all European stock trading. I mean, think about that. What was supposed to be a little side road for a few big trades became a multi-lane superhighway, and it completely changed the map of the entire market.
All right, so we get it, they're huge. But let's dig into the why. What's the incentive here? Why are clients flocking to them? And why are so many firms so eager to become one?
Well, the process itself is pretty straightforward. A client sends an order, the SI gives them a price, and the deal is done. Simple. Now, for a big client, this is great because doing a huge trade in private means you don't spook the market. But for the SI, the real prize for them is getting that first look at the order. That's incredibly valuable information, and it gives them total control over their risk. And that's where they make their money.
So SIS live in this really interesting gray area when it comes to transparency. They're not totally lit like an exchange, but they're not completely dark like a dark pool either. See, they have to show public prices, but only for trades up to a certain size, what's called the standard market size. Anything bigger than that, they can be more private. This is why you'll often hear them called quasi-dark venues. Kind of in the light, kind of in the shadows. So, what's the real bottom line for firms becoming SIs? It's simple. Profit. By getting that first look at client orders and getting to pick and choose which ones they trade against, they get a massive information advantage. And the research backs this up. It shows this can boost their profits by anywhere from 1 to 15% compared to a regular trader. That right there is the economic engine that makes this whole thing run.
But wait, the story's not over, not by a long shot. The regulators have been watching all this unfold, and now there's another huge shakeup on the horizon for 2025, and this one could change the game all over again.
So here's the absolute biggest change coming in 2025. The SI system is going from being mandatory to being voluntary. It used to be that if your firm traded a certain amount, you had to become an SI. No choice. But now, it's totally optional. Firms can choose to opt in if it makes sense for their business. This isn't just a tweak to the rules, it's a complete change in philosophy.
So yeah, the post-2025 world is going to look really different. First, as we said, being an SI is no longer a requirement based on how much you trade. It's a strategic choice. And second, and this is also a big deal, the job of actually reporting the trades to the public is being taken away from the SIs.
That's right. Instead of SIs reporting their own trades, we're getting new players in the game. In the UK, we'll have something called the Designated Reporter, or DR. Over in the EU, it's the Designated Publishing Entity, or DPE. And there's a subtle but really important difference. The UK model is a bit simpler, one registration per firm. The EU model is more complex, requiring registration for the firm and for each type of asset they trade. So definitely adding a new layer of operational headache.
Okay, so that's a lot of change. The big question is, what does this all mean for the markets going forward? Let's break down the potential impact.
All right, so what's the fallout going to be? Well, on one hand, firms get a ton more flexibility to run their business how they want. That's a plus for them. But on the other hand, this freedom comes with a whole new world of complex reporting rules, a real operational nightmare. And probably the biggest risk of all, making this whole thing voluntary could actually lead to more fragmentation, not less. As firms all pick their own custom strategies, the market could become even more chopped up and confusing to navigate.
And that really leaves us with the ultimate question, doesn't it? The first MiFID II accidentally created this massive quasi-dark market. So will this new, voluntary system finally achieve the original goal and bring trading back into the light? Or will all this new flexibility just give firms the tools to create even newer, even more complex shadows to operate in? The answer to that is going to shape the very structure of our markets for the next decade.
And just a reminder, this is not financial advice.